Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We continue our discussion on the topic of dilutive securities and earnings per share. So previously we have discussed about convertible bonds and convertible preference shares. So basically dilutive securities are securities that can result in increasing amount of ordinary shares, which will result in the diluted earning per share. Dilutes mean reduce, yeah? The decreasing value of earnings per share. That's why it's called as dilutive securities, because the securities can dilute the amount of earnings per share. Yeah? Okay, next we discuss about share warrants. Share warrants is the certificate that will give the option or the right to the holder of that certificate to buy the ordinary shares of the company at a fixed price stated in that certificate. Okay. So previously, if it is convertible bond or convertible preference shares, means when we buy the bond or the preference shares, at one point of time in the future, you can convert those bonds or preference shares to become the ordinary shares. Okay. But warrant is just a certificate that stated your right. Yeah, you have the right or option to buy the shares at the future. So it's not to convert, but it's the right certificate, and the certificate stating the right that you can buy the shares later on at a certain price. Yeah. So if it is a convertible bond or convertible preference shares, when the conversion takes place, when the holder wants to convert the bond or preference shares into ordinary shares, they are not supposed to pay any more cash, okay? Because they simply convert from one type of security into another type of security. But warrants, when the holder of the warrant wants to buy, to acquire the shares, they need to pay for the price of the shares, because this is not the conversion. This is just the certificate of option. Okay. Why the company offers share warrants? Normally, when they issue new security like bond, yeah, they want to make it more attractive. The bond issuance together with the share warrants, yeah, not the convertible bond, but the ordinary bond issued together with the share warrant, it becomes more attractive to the investors, yeah, or to the lenders. Yeah? Okay, and the share warrants is also applied for the existing shareholders to exercise their preemptive right. Remember, we discussed about preemptive right, which means that the existing ordinary shareholders has the right for additional issuance of shares by the company, yeah, to avoid takeover. If it is issued openly to other shareholders, then the company will have an extensive additional number of shareholders, yeah, and sometimes the company may lose control, yeah, if the outside shareholders are buying the shares of the company. So the share warrants is certifying that preemptive right. It's the evidence of the preemptive right. Yeah? To exercise the preemptive right, the company may make it in the form of share warrants. So there is a certificate stating how that the existing ordinary shareholders are entitled to purchase additional issuance of ordinary shares by the company. Okay. And sometimes the share warrants are given to the executives and employees of the company as a form of compensation, yeah, as a reward for them for their hard work or their performance. So they are given the share warrants, so they can get the option to acquire or buy the shares of the company. Okay? Okay, in the case of share warrants issued with other securities, so basically are long-term options for the holder of the share warrants to buy the ordinary shares at a fixed price. Yeah? The life of the warrants is 5 years and sometimes it is 10 years. So it's quite long-term in nature. So likewise with the convertible bonds and convertible preference shares, because we consider the instrument, the securities that are issued together with the share warrants, they are the compound instruments. Compound instruments means there is an equity as well as the debt elements in the instrument. So the with and without method should be used in allocating the proceeds between the equity and the debt components. Yeah? Okay, for example, this company issued bonds with detachable 5-year warrants. Okay, so warrants can be detachable, can be non-detachable. Yeah? Detachable means share warrants can be sold separately. It's not attached to the bond itself or to the securities itself. Yeah? But the non-detachable warrants are unable to be sold separately. Yeah, it has to be together with the bonds or the securities itself. Okay, so continuing the illustration, assume that the 5-year warrants provide the option to buy one ordinary share at 25 euro. The par value is 5 euro. At that time, ordinary share was selling for approximately 30 euro. And because giving the share warrants enables the company to offer to get the more attractive price for its bond offering. The face value is 10 million, 8.75% yield, and it's able to sell the bond plus the warrant at 10,200,000. Yeah. So the company record the proceed from the sale using the with and without method. Yeah? And using the calculation of present value of the future cash flows, it gets 9,707,852 as the present value of the future cash flow for the rated bonds. Means this is the liability component. Yeah? Okay, so by comparing the fair value of the bond with the warrant, yeah, this is with the with amount, yeah? And then the without amount, which is the fair value of the liability component, this is the present value of future cash flows. So we can get what is the amount of equity. Yeah? So the 10,200,000 is the with amount, yeah, the equity plus the liability, and then we calculate the fair value of liability component. So we can subtract it and we get equity component. Yeah? So how do we record the sale of the bond? Basically, we will receive the cash, 9 million, blah, blah, blah. So the bond is sold at discount, basically. And the bonds payable at 9,705,852. Yeah, but the company is able to sell the bond at discount because it offers with the share warrants. Yeah, so which means that the company will pay less than the amount that it received from the purchase price. Yeah, in the future. Okay, and then we need to record for the warrants. Yeah, cash and credit the share premium, share warrants, which is the equity component. Yeah? Okay, if we assume that all investors exercise the 10,000 warrants, yeah, one warrant per one ordinary shares, yeah, they want to buy the ordinary shares from the option that they get through the share warrants. So we need to record the cash receipts from the transaction. Remember, the fixed price is $25, despite the market price is higher than that. So basically, share warrant is attractive to the investors because it offers the price that is normally lower than the market price. Yeah? That's why people are willing to purchase the share warrants. Yeah? And we will close the account of share premium share warrants by debiting it. Remember, previously we have credited, and credit the share capital ordinary as usual, plus the share premium for the different amount. Okay. Okay, now we talk about preemptive right, which is the rights that are given to the existing ordinary shareholders to subscribe to additional share issuance by the company. Yeah? And normally it is formalized by giving the share warrants, by giving the certificates, yeah, to state the right of the existing shareholder. Okay, and likewise with other share warrants offer, the price is normally less than the current market value, because that's why it is attractive. And the company will not do the journal entries, and they issue the share warrants for preemptive privilege. They just do the memorandum entry to make sure that they have sufficient unissued shares. Yeah? If, let's say, that the existing shareholders will subscribe additional shares in the future by utilizing the share warrants. Okay? Okay, another application of share warrants is through giving the share options to the executives of the company. Also to purchase ordinary shares at a given price over an extended period of time. Yeah? This is like a reward for the executive who have contributed to the company's performance. So the company gives a share option for them, yeah, if they want to buy and become the shareholders of the company. Yeah? So the good thing about compensation program by giving the share option, because it will motivate the employees. Yeah? Will motivate employees to perform better and become part of the ownership of the company. By giving the share option through the share compensation program, it also will help to retain executive, yeah, and recruit new talent. The executive will feel rewarded and they want to continue their service with the company. Yeah? It also will be attractive to potential new talents from outside the company to join the company because they are aware of the company's plan to give the compensation program in the form of share options. Okay. Okay, basically, how do we measure the compensation cost or expense of the share compensation program or the share option program? The IASB through IFRS basically urge the use of fair value method, yeah? Which means the company use acceptable option pricing models. Option pricing models is a certain estimation method using the certain technicalities, which we don't discuss in details, but for the purpose of simplicity, the value is given. Yeah? So the main accounting issues which regard to the compensation program is basically how do we calculate the compensation expense, or how do we decide the compensation expense, and over what periods do we allocate compensation expense. Yeah? So as we mentioned just now, the compensation expense is calculated based on the fair value of the options. Yeah? expected to vest on the date they grant the options to the employees. Yeah. So basically, compensation expense is the difference between the market price and the fixed purchase price that we state on the share warrant or the share option itself. Yeah? And to allocate the compensation expense, basically we identify the service period. Yeah? How long that the employees perform the service, yeah? The executive perform the service, and we'll allocate that compensation expense. Yeah? For example, like this illustration, the company approved a plan that grants the company's 5 executives option to purchase 2,000 shares, each of the company's 100 yuan par value ordinary shares. The company grants the option on January 1st, 2019, so that is the grant date. Yeah? And the executive is given 10 years, yeah, for them to exercise those options. Yeah? So within 10 years, they are allowed to purchase or acquire the share at a fixed price of 6,000. Meanwhile, the market price of the share at the date of the grant is 7,000. Yeah? Okay, under the fair value method, the company computes total compensation expense by applying an acceptable fair value option pricing model. So this fair value option pricing model, it has a certain pricing model which we don't discuss in detail, but for the purpose of simplicity, it is given that the value is 22 million. Yeah? So we would allocate that compensation expense. And if the company assumes the expected period of benefit is 2 years, so we allocate that over 2 years because this expense, so we debit compensation expense 11 million and we credit share premium share options 11 million. And the same for the second year of the service period. Yeah? Okay, let's say 3 years and 5 months after the date of grant, and the executives of that company decide to exercise the 2,000 of the 10,000 options. Yeah? Means they want to buy certain portion of the share options, which is a 20%. Yeah? So how the company would record such exercise? When the executive exercise their right to purchase the price, means the company would receive the cash, yeah, from the purchase transaction of the shares. Okay, so they exercise 2,000, we times with the fixed stated purchase price on the share warrant, which is 6,000 yuan. So debit cash 12 million. And we close down that share premium share options account 4,400,000, and we credit share capital ordinary, and the balance goes to share premium ordinary. Yeah. Okay, if the executives are not exercising until the end of the stated period, which was 10 years, right? If you remember the illustration. So the company would record the following at the date of expiration. They would close down the share premium share options account, and it transferred into share premium expired share options. Okay. Why it is 17,600,000? Because it is the total compensation expense. We multiply with 80% because 20% was already exercised in the previous period. Yeah? Okay, if the total compensation is measured at the date of grant, can it be changed in the future period? So basically, it depends on whether the adjustment is caused by a service condition or market condition. Yeah? What does it mean? Just now, let's say it decides compensation expense was 22 million at the date of grant. What about in the future that the company wants to change that amount? Yeah? So that basically depends on the service condition and the market condition. Yeah? Okay, now we talk about restricted share plans. Yeah? This is like compensation share plans, but with certain condition. Yeah? So the company stipulates certain condition for that share to be able to be exercised. Yeah? It has certain terms for the employees to exercise these restricted share plans. Yeah? Among the terms or conditions that must be fulfilled is that the share plans cannot be sold, transferred, or pledged until vesting occurs. So it cannot be transacted, yeah? Cannot be sold, transferred, etc. Yeah? Okay, the restricted shares is normally a very small percentage of the total unissued shares of the company. So basically it results in the less dilution to existing shareholders. Yeah? And it also makes sure that the employee will have an aligned incentive with the company incentive. Yeah? Because it puts certain restriction or condition into the share plans. Yeah? For example, the company issues 1,000 restricted shares to its CEO. Yeah? And the company's share has a fair value of $20 per share on January 1st, 2019. Yeah? The additional information, service period related to the restricted shares is 5 years. Vesting occurs if the George stays with the company for a 5-year period. Yeah? So it has the condition that the CEO must stay for 5 years, only they can exercise that share plan. Yeah? And par value of the stock is $1 per share. Yeah? So on the grant date, January 1st, 2019, the company will do the entry of compensation expense, but they will include it in unearned compensation because it has not been exercised yet. Yeah. So we debit unearned compensation and we credit share capital ordinary and the balance share capital premium ordinary. Yeah. Yeah. So unearned compensation is like an expense that yet to be happen, yeah? Or cost of service that is not yet performed. Yeah? So it is not an asset. Yeah? It is reported in the statement of financial position as a contra account to the equity. So it's like treasury shares. Yeah? It will reduce the total equity amount. Yeah? So on December 31st, at the end of the year, the company will allocate the compensation expense. Yeah? So debit compensation expense and credit unearned compensation. Yeah? This is like unearned revenue, yeah, or prepaid expenses. Okay, so you write off at the end of the period for over the period of service. Yeah. So because it says that 5 years, the executive or the CEO must stay in the company for him or her to be able to exercise the shares. So the compensation expense will be allocated over the period of 5 years. Yeah. So 4,000 per year. Yeah. From 20,000. 20,000 divided by 5, so you get 4,000. Okay, let's say that CEO leaves the company on February 3rd, 2021, before any expense has been recorded. Yeah? So means that executive doesn't exercise its share plan, a share compensation plan. So we close down all the related accounts to this restricted shares plan transaction. So we debit share capital ordinary, share premium ordinary, the one that we record on the grant date, we credited already on the grant date. So now we debited because we want to close down all the records. Yeah? And we credit compensation expense. Yeah, why we credit this? This is the restatement. Yeah, previously we have debit for 2 years. Yeah, now we contra it. Yeah? We make the contra entry by crediting the compensation expense, and we credit the balance of unearned compensation. Yeah? So means we close down all the related accounts to this transaction. Yeah? Okay, besides the share compensation plans for the executive, there is also an employee share purchase plan. This is dedicated for all other employees. Just now it was only for the top management position like CEOs, CFOs, general managers, senior managers. Yeah? So there is also a share plan for the ordinary employees, yeah? The ordinary staff in the company. Yeah? So this plan allows all employees to purchase share at a discounted price, and normally the period is short, yeah? As compared to the executive plan just now. For employee share purchase plans, the period of time given is short. Okay. So the company has to record an expense of the service period as well. Okay. Okay, let's say this company offers its 1,000 employees the opportunity to participate in an employee share purchase plan. And under the plan, the employees are entitled to purchase 100 ordinary shares. Par value is 1 per share at a 20% discount. Yeah? So the share plan always offer a discounted purchase price, yeah, below the market price. And the purchase price must be paid immediately upon acceptance of the offer. In total, 800 employees accept the offer, and each employee purchases an average 80 shares. Yeah? So the employees purchase a total of 64,000 shares. So basically 800 employees multiplied by 80 shares, yeah? Because each employee purchased 80 shares. So we get a total of 64,000 shares. The weighted average market price of the shares at the purchase date is 30 per share. Yeah? And the weighted average purchase price is 24 per share because it has a discount of 20%. Yeah? So 20% times 30, you get $6 discount. That's why you get a purchase price of 24 pounds. Sorry, not dollars. It's pounds. So how do we record the journal entry of this transaction? So the amount of the shares that is purchased by the employee, 64,000 shares, multiplied by discounted purchase price, which is 24. So we debit the cash, and we debit the compensation expense, which is the difference between the market price and the discounted purchase price, and it gives us 384,000. And the share we credit as usual, the share capital ordinary and share capital premium. Yeah? Share premium ordinary, sorry. Okay. Okay, what do we need disclose for the compensation plans? Yeah, let's say the company has various types of compensation plans. So the company has to disclose the nature and extent of share-based payment arrangements that exist during the period. Yeah, it must be disclosed in detail. Yeah, and how the fair value of the goods and services received, or the fair value of the equity instruments granted during the period. Okay, and its effect of the share-based payment transaction on the company's net income or loss during the period, and also on its financial position. Yeah? Okay. So there is a debate on whether to use the fair value method or intrinsic value method. Intrinsic value model is basically the difference between the market price and the stated purchase price on the share warrant. The fair value method, you have to use certain fair value model calculation, yeah, to identify the compensation expense. Yeah? But ISB is basically is more preferable towards the fair value method. If you notice, ISB is very much inclined towards the fair value method. Okay, I'll record another part on earnings per share. We stop for a while.